Most LPs are familiar with multifamily, self-storage, or maybe even private debt funds, but very few understand the quiet workhorse of commercial real estate. And in this episode, I am joined by Judd Dunning, president of DWG Capital Partners, a firm managing over $100 million in assets across 10 states using the industrial triple net sale-leaseback model. That's a mouthful. His team works with over 300 investors, including family offices, and focuses exclusively on acquiring these buildings for logistics and distribution facilities leased to American businesses. And in this episode, we will break down what a sale-leaseback actually is, why industrial tenants are willing to sell you or Judd their building and then pay rent on it, maybe how this strategy compares to traditional real estate, and then what LPs need to understand before allocating capital to this niche. But I am very excited to have Judd on the show. And with that, let's dive in. Welcome, Judd.
Thank you so much, Pascal. Great to see you. Great to see you in Miami. Great to be on the show.
Yeah, I'm excited to have you here. So a little bit of background. When I initially met Judd a couple of weeks ago, actually, at an event where he presented his kind of latest offering or deal that they're putting together to an investor group at a sick mansion in Miami. And so I got to know him personally there, and also got to connect with another fund manager actually that also helps raise capital for your firm. And so it was cool to kind of have that dynamic all there. Can you maybe talk a little bit more about just that type of event that you sponsor and why you do that?
Yeah, great. It's interesting because after 20 years in real estate, a couple billion in transactions, and going into this space to make our friends and family and colleagues wealthy versus Goldman Sachs and Chase Bank, we've been doing it a long time. The first 2.5 years, we were just behind our desks. I mean, COVID hit. We did our first investment in the middle of COVID on this particular platform of industrial sale-leasebacks. And so we just said, hey, we've got to get out there and meet the people that are investing with us. And through Zoom, we've all become very good friends. So we called it the Industrious Tour, and we just did Northern California. It was great because they're heads of the people that are invested, heads of Microsoft, heads of Google, Indian people from all over the world. We have every sector, every type of people. So we just got to finally get to that face-to-face level because we tried, we do think like it's more time for our LPs to have time for God, nature, and family. And, if you work from the heart, so we got to do that series. And then we went to Miami. We did another one. We just did in Newport. And so funny enough, a friend of mine, not that I would spend the money, but someone gave me an unlimited American flight pass. So I'm just saying, hey, I'll fly in and meet you. So I think it's really important to cross the tech border and meet the people. And it's been fantastically enjoyable for us.
That's awesome. Great to hear. So I want to dive straight into the heart of the episode. Just to give everyone an overview. First, I want to cover triple net leases as an asset class compared to maybe the other types of asset classes you can invest in as an LP. I want to talk about DWG's specific strategy, and then, talk about the risks and what we should know as an investor as we're thinking about maybe evaluating deals in this asset class. And then we'll wrap up a little bit with Judd's story. But Judd, can you give us that high level overview of what is a triple net sale leaseback in simple terms?
Great. Yeah, let's break it down. Triple net, right? There's gross rents where they just give you rent. You can pay everything else. The structure, the taxes, the insurance, the management fees, everything come out netted out of a gross rent, right? Then you have a modified gross rent where you might be covering taxes, insurance, deferred base, but you might not have roof and structure. And
give me examples of like who would fit in these different categories.
Sure. Gross rents would be a lot of like Class A office building. They just pay one rent number and you pay all your expenses. Another gross rent would be all multifamily almost, right? It's like all the expenses are handled by the multifamily operator. It could be mom and pop retail. It could be mom and pop office. But it generally, like Class A office, you're going to see a lot of like gross rents. Like they'll pay you a higher rent, you pay everything else. So that involves expenses and certain eccentricities and the movements. Every area has its common custom of those costs and expenses. It's not the same across the United States. So it does create a little risk because you never know what the operator is creating in the expense column before the net operating comes to the investor and then goes into the distribution. So gross rents are very common also in industrial as well, and lots of types of industrial. So gross rents are, they're multifamily across every asset class. Modified gross could be everything with roof and structure, as an example, or maybe they don't pay the taxes. An example of that would be the same. It goes across every asset class. Absolute triple net is everything covered. Gross rents, modified gross, and then triple net, and then absolute triple net. Absolute triple net is like nothing. No man, call them the mailbox popper. So, they send you a check, they pay the taxes, they pay the insurance, they pay the utilities, they handle the deferred maintenance. There is no management fees that are outside of your GPLP relationship. Everything goes straight to the investor.
What falls into that last category? Like, what would be an example there?
Walgreens. You're going to get, almost any retail, right? You're going to get Burger King, Walgreens, any of the triple net asset classes, DaVita's, for example, medical office buildings. What else? A lot of office buildings will be triple net as well. But
what is
one that most people think of triple nets is like a retail mailbox, a Starbucks or a Walgreens would be the investor's first thought.
And so the key difference is the company wanting to have complete control over the experience.
Really, I'd say absolute triple net is really more is owner friendly than tenant friendly, but they have to fit in the box and the norm. So capital markets are what? Capital markets in the United States, everybody hears those terms. It used to be just debt and equity, Pascal. But capital markets is the intersection of expectations with how rents are paid, how debt is paid, where banks will finance, lease standards in certain areas and asset class. So the norm in capital markets usually dictates what the person, like a Walgreens person doesn't come in and say, I'd like to have gross rents. You'll see that those standards are pretty much set by the consumer in that free market capitalistic exchange of what is normative.
So help me understand, why would a business want to sell its property and lease it back, just generally?
Okay, so jumping over to industrial sale-leasebacks, which for us are absolute triple net. There's a reason that they're absolute triple net for us too, because we're so focused on underwriting the business and creating this vehicle for them and empowering their business. So Pascal Wagner Incorporated owns a 100,000 square foot industrial building where he manufactures Beats Pro, right? So just products, and he's been doing it for a long time. And he bought the real estate originally thinking, hey, I'm going to own real estate and I'm going to run a business. But his business starts doing really well and people want more Beats Pros. So he says, I need the money to get that money out of my real estate. I want to invest my real estate. I want to sell my real estate to someone. I want to lease back and I want to become the tenant, use that money and grow my business because I can make more money in the business growth than I can in the real estate.
Is this general triple net leases or your model? I want to focus high level first.
High level,
the
sale-leaseback space is predominantly triple net across the United States. Yes, sir.
Okay. Fascinating. Okay, so they basically just realize like it's smarter for me to push my capital in my business than to have the capital in the real estate.
Right. And they're driven by the tightness of the markets. Debt's been really high. Instead of going to their bank, they'll go ahead and divest their real estate, right? We're going to put new debt on the property in our name and we'll own the real estate. We're going to give them equity. They're going to pay down their debt. They're going to eliminate the rent expense and a lot of their other expenses. They're still going to be triple net operators. They're going to cover their own taxes, their own insurance, their own deferred maintenance, their own roof, their own structure, their own accounting. They're going to give us one check and they're going to pay the rest. It doesn't even come to us. We don't see the taxes. We don't see the insurance. We don't see anything. It's just a clean exchange. There's a reason for that because when we come into an American mid cap and small cap business and we take their real estate in a sale and lease back, we don't want to run their business. We're really financing their growth. we're not in the business of managing all of their expenses. We're like a financial vehicle to empower American business to grow.
So can you tell me a little bit about like how does triple net lease compare to, let's say, other asset classes like a self-storage or a multifamily? Like what are maybe some of the key components that differentiates triple net as opposed to any other asset class that an LP could invest in?
So triple net industrial sale leasebacks are all sale leasebacks because you can lease back office, you can lease back retail, which is also fairly normative. So would you say industrial sale leasebacks or sale leasebacks in general?
I want to talk about this at a high level first. We're going to talk
Okay.
about your strategy in a minute, right?
Yeah. No,
But I want the I,
we're here for the investor. We're here to be of service. So yeah, the sale leaseback space. Well, if you come in and you empower a business to get 100% of their value out of their property, 100% of their value out of the property. So they go to their bank and they might get 65, 70%, right? And they still got to come up with the equity. So if they're going to get 100% cash out of the value of their real estate, and we're going to take the guarantees or create the financing, right? We're usually getting a little bit above market rate versus going out and just buying in an investment sale, right? It's a different exchange. Like everything in American real estate is an exchange of risk and value. So when I come into a company, I sale leaseback, I'm saying it's almost a joint venture. I'm saying, I believe in your business. I believe I'm going to take your $100,000 rent and I'm going to pick it up 12 months at $1.2 million. We're going to do a 10-year lease. So for $12 million, I'm going to put your rent into a vehicle. And for that, I'm going to get a little bit more value. So I might get a higher cap rate because I'm saying Pascal Wagner beats Pro company. I believe in your sustainability. And you're going to say, well, thank you, sir. Instead of a 6 cap for selling this Walgreens, I might give you an 8.5 cap in the exchange of risk.
And say cap in layman's terms. Like you're going to get a 6%, an 8% return on your money versus a 6% return on your money.
Absolutely. The simplified measure to the cap rate for our investors is that you take the net operating income after expenses or absolute triple net or after average structured, you divide it through the value of the building as a measure of the building's ability to capitalize an investor coming in to capitalize debt. So a capitalization is the propensity of your income divided straight up. So to simplify, right, a 10 into 100 is a 10 cap. So let's just use $100,000 of net operating income divided upward into $1 million is a 10 cap. Now there's general rule. There's a couple rules for a new investor. One is if it's a 33% IRR, you might buy it because that means you're going to double your money in 3 years, which is not normative. So you sprint, as they say, shoot first, ask questions later. So go for that deal, try to capture it, and then figure it out, right? On a cap rate, 10 cap is a standard. That's a heck of a deal. Very hard to achieve a 10 cap. And think about where debt is. Debt in America, if I could just cut here, is about here, about 7% on commercial property right now, generally, right? So you have a spread here between the cap rate and the debt, which is the next level of why does the NOI capitalize the deal? It also capitalizes the cash flow. It capitalizes the debt. It's a great measurement. So as close as you can get to a 10 cap is always the game. You're selling as close as you get to a 1 cap.
Okay, cool. So can you help me understand like triple net as opposed to self-storage? Like what is a key difference? A key difference is self-storage, you're probably renting to a consumer. And triple net, you're renting to businesses. And so there's pros and cons to that. What like can you like compare the asset class to other types of real estate that you'd be investing in?
Interesting in self-storage, right? Because self-storage is driven by demand. A lot of people are cramped up in small apartments now because of inflation and housing issue. People can't buy houses. So demand in that space is awesome right now. It's a really interesting asset class. But you're renting to mom and pops. So each one of those tenants, just like an apartment, is its own defined, diversified risk. So you might have 100 storage units. Now, if it falls below a certain number of occupancy, 80, right, then you might be in trouble. You're getting to a high vacancy. You might have issues paying your numbers, right? But in triple net, you're getting one payment on 100 storage units. And it could be on, by the way, there's a lot of triple net self storage. So the owner might go, hey, instead of you dealing with all the headaches here, I'm going to give you one check. I'm going to master lease this to you and pay you. Then I'm going to have the spread down here. And that's actually good for them because once they step in the middle, those storage units might be get more and more expensive and they'll be making more and more money. So, you're not going to, that's the difference between being a business operator and an investor. So yeah, it's the same in apartments, right? I mean, apartments are driven by very basic human need, and you diversify risk by having a lot of different tenants. But you understand that people can't buy homes the way they used to right now. America is very expensive, market's very high, inflation's being reset. There are a lot of variables there. So triple net, you don't have to deal with the human issue. Now, it's a quick sidebar. I've sold 15,000 units, and I sold a lot of them during the crash because I'm also a broker. And there would be fires, murders, water floods. I mean, all the time, you're fully exposed to human experience of need, crime. And in triple net, you just pick up the check and you pay your mortgage, and you take your cash flow, and you pay your taxes. So there's beauty in exchange in each of those. But you can manipulate a lot of the variables a lot more if you have 100 tenants. You can turn over tenants. There's a lot more to change. There's a lot of upside, once again, to the exchange of your human labor.
Fascinating. And if you were to go into the triple net space, like how do different triple nets, like if you're an investor investing in triple net retail versus triple net office versus triple net industrial, which is what you guys do. What are maybe some of the nuances or like of the asset class itself?
Well, the first one is credit, right? Because you are relying on one person to pay a check to protect you and your family's money in the mortgage. So you buy a deal, you take your hard-earned money or group of friends, and that is your equity, right? And then there's your debt. And that person's, I use a little rule in real estate. I said, never do a deal you wouldn't do in a handshake. Always look a little on the table for the other guy and take the high road no matter what. And that means pay your bills on time, take your taxes, and take your insurance. So when you have a triple net lease, you are depending fully upon the integrity of the covenant, a single payment, providing your cash flow, providing the operator, who business owner is, right? Providing for your debt payment, protecting your credit, and protecting your family's wealth. So the first nuance is my dad said horse stance. He said, I said, Dad, how'd you get so successful? He's like, horse stance. I'm like, God, I don't know what to do with that, Dad. But the truth is you have to have a sense for people, and you have to be willing, even if you're a new investor, to ask questions. Do you have any bankruptcies? Do you have 3 referrals of people that you would like to share with me? How long have you been in business? How long have you been in this location? Why wouldn't you leave this location now? How sticky is your relationship to this building? So, tenants, a good example. Guy was going to buy something the other day. It's a really huge example. And he said, hey, man, this is my dad's worked his whole life and he hasn't, this is everything we're worth. They sat on land. They're worth about $10 million. This is this week. And he said, my dad, he just protected us. He said, if something went wrong with a single tenant lease, he said, I think my dad would die. And I was like, okay. I said, I don't think it's the deal for you. I said, there's always inherent risk. He's like, what happens in bankruptcy court? And then I'm saying that if you don't feel that comfort level and you know what you're doing, then don't put all your eggs in one basket in the triple net space. That's the most important thing because you're putting it all on black. You're saying, I trust you, Pascal, Wagner, and your beat production line and forever.
Wow. Fascinating. So that's pretty much the difference is like you're betting on maybe a grocery store, staying in business versus, Beats Incorporated or maybe a dental office. And so like the difference maybe is not like triple net is the strategy. And then like basically depending on what type of asset class within that you do, that's all based on the type of business that you're underwriting.
Yeah, absolutely. But that's taking the assumption, very important. The second thing the investor should think about is he should think about the land, location, location, location. So we said credit, credit, credit. Tony Robbins has a saying, says redundancy is mastery, redundancy is mastery. Redundancy, my staff hates it, but it's credit, 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 location, location, location. So you may not want that client, that triple net person. It may cover it. It may be a land play. So your family has $1 million and you put it in downtown Phoenix, and this guy, maybe he doesn't. He only does 10 million a year. That's only one lawsuit away. It's not easy. It's easy to wipe out $10 million of sales, right? One bad season, someone's an alcoholic. Someone gets into a horrible divorce. We have a rule. I try to go for credit over 25 million bucks. I have a saying, my own saying. It's like, $25 million is a hard American candle to snuff, because it takes a lot of energy for people to get their sales to 25 million and enter the range in which private equity started to pay attention to them. So, but it's okay to go with a mom and a pop who's maybe making 5-6 million. Why? Because if they leave and rents for $3, and in 6 years rents are $7, and they leave and you fix up that site, that single tenant site, and you lease it to somebody else, then suddenly you just paid a few $1 million because of the location, location, location. So credit is it's a metric.
Understood. So there's really two factors, and I know we talked a little bit of this about the way that you guys invest is like, you're maybe this is a good time to transition a little bit, but you specifically focus on industrial spaces by highways and roadways, which are all, I imagine, based around that second part. So the first is you're investing in a certain type of business, and it sounds like a certain type of business size, 25 million in sales minimum. And then you're also only looking at deals that are around specific areas because you don't want to be too far away from the hotspots. Do I have that right?
The second part, not as much, because if his credit is good. So a lot of the founders of America in the industrial space, which I think is fantastic. And by the way, we don't have to talk about my business today. I love, I'm fine with it, but I love this stuff. I've been doing this for years. I love American real estate. I love every asset class. It's so fascinating. So feel free to just, as much as you want to talk about them. And if you want to get a hold of us, like talk to us later. But would you repeat that question? Because I want to take it at a certain angle.
Yeah. So we were talking about the first part is underwriting the credit worthiness, and the second part is location around highways and your strategy. And you were saying that I didn't quite have that right.
Oh, thank you. Now I know where I was at. So I want to say a lot of the American founders started their company in a field down in Texas. So industrial might be in the middle of nowhere. A good example, we took a gamble on a company outside Houston in Sugar Land. And it was like $9 million in sales. But I was in the right place, the right time, the right cap rate, close to a 9. And the yields were good, and I got good debt. And then, they got bought by Denver Glass, and they rolled them up multiple times. Next thing you know, they had 100 million in sales. And I had a low debt rate that was assumable. And we knocked it out of the park on this deal in the middle of nowhere, because we knew there was a possibility, and this is our game, credit can improve. So in America, this is a great statistic, 85% of businesses fail. The ones that don't become IBM. So the people that are just getting up and running, it's hard for a lot of them to fail. Like, you have to respect, and Americans, we're tough people. So, we'll take risks that are smart and intelligent. They don't have to be infill. The infill ones, infill meaning inside of a city, inside of a metro, in good location, those are going to have lower cap rates. They're going to be more competitive. So you're always balancing the distance from city. One other interesting point, why are industrial buildings outside the city? Because they need the trucks in the room, and the land is cheaper. So they'll say, well, what's the cost of gas for 20 miles versus the cost of land? So that's why you buy industrial. We call it the not sexy asset class. Because whenever you're leaving a city, you smell industrial buildings, like you can't even find a taco. Let's get out of here. And that's where a lot of the great value lies.
Fascinating. Okay, I would love to kind of take a moment and dive into your firm. So your firm has over 100 million in assets across 10 different states. Can you talk to us a little bit about like what the makeup of that is? Is that like 20 assets? Is that, what's the minimum and max size? Help us understand the what your portfolio consists of.
You bet. So the thing about buying industrial sale leasebacks, which by the way is for the bold, find a good LP like me that doesn't like to sleep, because there's a lot to navigate. You have to figure out the credit, you have to figure out the debt, you have to figure out the business, you have to figure out the stability, and then we create it really simple. People get to call us the click of the mouse, off the house, invest through us. So I have the honor of bringing the sophistication of sale leasebacks to high net worth democratized investors, which is a great pleasure to let them come along. Our space is driven often by a merger and acquisition. So somebody wants to buy a business to roll up that business and maybe add another business and grow a bigger business. That's America is endemic right now with just private equity roll up. Blackstone, BlackRock, Vanguard, State Street. Everybody's buying up and aggregating. So this particular time in history, we are usually buying something not because we're like, oh, I want that site, I want it in this area, I want that number. We're buying it because that business is being bought by someone else, or they're divesting their real estate to get bigger so they can try to be bought by somebody else. So we fit into the capitalistic structure of enabling, we say, Americans backing American businesses. So I wish I could say, hey, I want to buy this deal in Miami, but I might get a call and it's in Cleveland, and I'm like, let's go, because we believe in American businesses. So our thesis is important. So if you look at our portfolio after the pandemic, a lot of distribution, logistics, and property and population change shifted to what we call the magical Midwest, because you're by Chicago and Oklahoma and Texas and Chattanooga, everything. So if you're in the middle of the country, distributions and logistics, onshoring is happening. There's a lot of onshoring. Trump's really working on that. There's a lot of variables that are changing. Suddenly Columbus was one of the hottest markets in the nation. Suddenly South Bend was top 10. Suddenly Hudson, Michigan. So we're seeing activity in those areas that I own in. And we're in the middle of buying. And we're like, how is this NAR's top 5 city for residential growth? Or we just were active in Montgomery, Alabama, which has the biggest high-tech, highest educated immigration of talent because of Facebook. All this changed and distribution blew up. Nobody wants to go. My wife, last night, the groceries came by delivery. And I'm like, is that necessary? I'm sure everybody can relate. And I'm like, why are all these packages stacking up the door? No one's been talking to dad, So everybody's really gone online. But another thing was happening was all of our manufacturing, logistics, third-party logistics all shifted to the center of the country. So we find ourselves investing heavily in the Midwest and the Southwest, but we also own assets in Spartanburg, and assets in South Bend, Indiana, Columbus, Austin, Phoenix, Longview, Texas, up north as well. We're buying something in Arkansas right now. Just did a deal in Wisconsin, which does prefab walls. Austin does iron. Airbags are being done by a car company in Phoenix. Paints are in South Carolina. So we're investing in what we call essential consumer businesses without customer exposure. We're not buying businesses that sell directly to the consumer. We're empowering American industry. So we're backed by M&A mergers. We're backed by the change of logistics in America. American industrial was very interesting. If I can deviate for 1 second, one of the reasons I got into it was because I'm 59 on Tuesday, and I've been around generations of real estate. And my biggest thing that I can tell you is, why didn't that? Everybody's like, oh, why did I buy that? My dad had like 30 properties in Highlands, North Carolina, and they're worth 120 million. And all of the really country third generation people are like, man, I'm rich. And we moved from Glenwood Springs. We moved from Moab. We were always in the room. My dad had a restless spirit, and I've been in multiple asset classes. So what we did is we stuck to our thesis through COVID, and we kept buying. And Morgan Housel said, get your thesis, just keep plodding through every economy, and just keep America is, rock and roll, keep going. And so we've been able to, with a practical thesis, we wait for M&A to happen. People call us, And we love buying businesses, across America as opportunity calls us to do so.
I love that you brought up the thesis. That's something I talk a lot about on the show, and I think is fundamental to you being an investor. And I find that as a retail investor or as a new LP, you're not necessarily taught how to think or how to put together a strategy or how an investing strategy evolves. And so I love that you highlighted it, and I would love to double click there and maybe talk about, you don't just wake up one day and say, oh, you know what, I'm gonna focus on industrial, triple net leasebacks in the Midwest, and that comes from somewhere. Can you talk to us a little bit about maybe how that thesis came to be and maybe how that's evolved over time?
Yeah, there's two routes to that question. The first one is when you went from Keller Williams commercial, and I was in film for 20 years, and I've been, so 18, 20, 20. So I've been in commercial for 20 years, 20 plus years, 22 years. And in Keller Williams, the first thing I was doing malls across the United States where you have Bonefish Grill or Publix or Walgreens in them. And then a developer would get the tenant. And then I called a bunch of people in Israel, and I had like three different nets, and I had different names. Nets. I was new. I didn't know. I needed to order. And people call, and I'd bait and switch them, and I'd put the address of on my dad's properties and switch it over. You go, well, but I have this. And this developer busted me. He goes, what are you doing? Selling my properties, And then I flew in, and working for that developer. But I was putting together syndications of, investors. And I was breaking the blue sky laws. I think I'm way beyond the law at this point. I didn't know what I was doing. I was like, this is amazing. Let's invest. Well, that's why you see in movies. I used to bring together, I had like Mickey Rourke and RuPaul signing it, like worst part of their career. It was a long time ago. So it translated my family's fourth generation real estate, just to clear everybody up. I kind of did this for a few years. And so I was bringing people together, and I was immediately looking at the IRRs, the cap rates, and the spread on development. And I was lucky. I had a great mentor. I understand the fundamentals that we could go anywhere in the United States, put it the right debt on the right property, build with the right tenant, and create the right outcomes that people would want to invest. And I did like 7 or 8 my first year. I was rookie of the year out of 150 people. And then they're like, what are you doing here? We sell houses at Keller. And so Sperry hit me. And then I started doing it across the nation. So I was doing like, swaths of Wendy's and Home Depots and Walgreens and malls. And then some guys at Newmark found me before the merger, and they swept me up. There was the Guardian merger. And they took me in and started calling. The market started crashing. We started calling on CMBS loans, and everybody's loans were failing in 2007 and 8. So this guy said, you're going to come work for us, and you're going to call loans. And I called some guy, and I got $180 million assignment. I was like the new kid on the block. And suddenly I was going into banks, and I was working on, 20 assets at a time for Citibank. And somewhere in Philly, there was one in Philly, Pascal, where I was going to fly in, and there was a murder curfew. I mean, I did every type of asset across the United States, and the banks loved us because we're like, these banks are people. They're not the bad side of our economy. There's people behind banks, right? Every business comes out of a person originally. So we're serving the banks, and we're solving all these problems. And the nefarious activity I saw in borrowers when plenty of the dark paper was going on, it's crazy. So I would come in, I'd bifurcate the debt into stacks. I would sell the note for the FDIC. I would come in and I would recap the owner. I would foreclose. I would put deals in for receivership. So capital markets ended up letting me understand every asset class across the United States. And then Newmark went into the merger. We got very big, and I left at 50. I gave myself a 50% raise, which I think is appropriate. And we kept doing the same thing. I sold Sony Studios for a couple $100 million. And we won our Deal of the Year award here at Los Angeles Business Journal. So we got back credence and credibility post-institutionally. And now I was like, well, what's next? So I served a very big corporation, and I know somebody who was studying other REITs business plans in their basement who was smarter than me. And, I helped save them in some rescue capital very quickly, because I also, we're doing $1 billion of debt and equity still right now, still a brokerage firm as well as a principal firm. We got a bunch of wonderful people work for me. And, that person said, that was amazing. He said, I want to share with you what we do. So they've gotten bigger and bigger and bigger and bigger. And one of my best friends has become a luminary in this field. And I selected a subclass that, I'm not, you know, be too hard on them. We're 50,000 to 250,000 small to mid cap. And now they're doing the big deals in America. So we just chose an asset class that I really love. Last piece. So the thesis was an evolution of triple net, nationwide, agnostic, love America, power people. And I've done a lot of JVs. I've star made a lot of people bringing in the money for others before I pivoted to my own world. And one day I was like, well, why don't we just make our friends, why don't we take all this to our friends? And when I started doing that, it was a lot of fun. It was just a lot of fun. And that's how our thesis evolved. And since then, funny thing people don't realize is once you start, when you become an agent, you don't know if you're going to succeed. When you become a broker, you don't know. When you become an institutional guy, you don't know. When you leave the institutions, when you syndicate, you don't know. Started, back in my office, just calling people. But we are like sharks. Once you start, you have, 15, 20 people. You have to swim as a leader. And so you keep moving. And the necessitation of taking on responsibility of care. So you care for your clients, you care for your staff. And then you're like, well, I'm the patriarch of this vehicle. And then the refinement of excellence happens because you have to take care of the investors and take care of the staff. And you lead this American family, the headwinds of real estate, which has been a little tumultuous, but we've done 7 deals since November. So we're very active.
Can you talk to us a little bit about the political landscape and what you see? Maybe not like what side you're on, but more around there is a seismic shift happening in the United States with the Trump administration bringing manufacturing onshore. And I imagine that you have a front row seat to that. And can you tell us what you see happening, what you see happening over the next 3 years based on what's already happened? Give us some insight into what's going down, because
The caveat of caveats here. Judd Dunning's not to consult your accountant and your tax attorney. No kidding. I'm pretty comfortable, actually. So if you look at the Fed, let's start with the Fed, right? So the Fed, if you look at their discernible pattern over the years, you can actually discern it. We have that in our decks, which is they reduced the rates 190 basis points over 21 months from a peak when they start heading the other direction. During the Gulf War, the dot-com, and the 9/11 crises, when they had to, they also decreased rates as fast as they increased rates to take care of the economies and the banks. So the Fed is discernible. But I call this TRS, Trump resistance syndrome, because regardless of whether money is not blue or red, it is green. And you have to take a position from a place of neutrality. So I have to quantify, well, what does that mean? Because it's higher for longer, we've been hearing, right? And so I'm going to take 33%. I'm going to apply it to 21. I'm going to say, okay, 190 basis points, 200 basis points lower debt rates. I'm going to use 36 months. So I'll use 3 years. So you have to make a decision. You can't just let the ephemeral gods. Real estate's a pretty definable industry, right? I mean, almost everything is ultimately like you do your best with the numbers, then you plan for about a certain variation. Everybody lost a lot of their confidence during COVID because it was an anomaly. But America chugged right back. America, like we work so hard and we better ourselves and we overspend and we consume and we crash. We do it again. But real estate keeps doing this. Health insurance keeps doing this, right? There's so many different variables that just don't adjust downward. America just keeps chugging forward. So look as the Fed. I think the new inflationary standard is probably going to push to 3 in time. We're focused so much on trying to normalize inflation to these pre-COVID era, pre-globalistic society. I don't know what's going to happen there. Inflation's so high, moving so high, wages are moving too, to a certain degree. So it is a different landscape. So I would say, first thing I'd say is look for interest rates in commercial and your houses to drop about 200 basis points, but give it about 3 years. It's going to take some time. It could happen quickly, but the pressure is so high. And why do I say it's Trump resistance syndrome? Moody's came out, they downgraded work. Thank you for helping. And then the Fed came out and said, I don't think I'm not affected by politics. It's like, really, it's like this, your show right now. Your show is not about me. It's about helping people, right? That's the most important thing. So, I think that we have to keep our eye on like, what do people need to focus on? And that's, you should be able to refinance in a couple of years. So that's the first thing. That's where I think rates are going to go. Secondly, multifamily is fragile because we are hitting what I call the inflationary ceiling, driven by individuals and families and people. Eventually, people will move out of the cities. Austin rent growths have gone negative. They went negative in Los Angeles. You can leave these metropolitan areas for lesser areas. So with multifamily, you should be wary of assumptions, but very bullish on the sector because people are driven by need to multifamily. It is the intersection of need, apartments and life. Most people, the average American couple makes less than $65,000, and there's only 3.8 million people in the top 1%. It's like there's definitely a discrepancy in the country. So multifamily retail's warming up. People have returned to life with a passion. So I think that they like to engage. So look for Amazon exposure, know your tenant, know the competition, be hyper aware more than you used to be. But retail's starting to make a comeback. It's moved into like second asset class. Office, still decimated. Look for the location of the office. Owner users definitely need to get into the middle. The small stuff is moving. Mid-level stuff is tough space. Class A office is doing pretty good. Leasing is heating up. Last week, Cushman Wakefield, JL, Newmark, Easthill, and CBRE all came out for the first time and said, America's coming back. And right after we did that on our team, because that's kind of my microcosm, I've had like 15 listings going to on the brokerage side going to contracts. Like, we're definitely moving back. So pay attention. Industrial's cool, man. I like it because it's such a fun. It's triple net, but I have fallen in love with the American worker, and we are starting to buy some businesses because of that. I love Ohio. I love these. I mean, you meet these people sitting behind a machine. A lot of them are zen. They're just patriotic, good people. They know how to sit still. They care. So I was in Italy recently, and I was like, "This is amazing." My first big trip to Italy, and I said, "Well, why is this not better than California? It's as beautiful as California." And I looked it up, and the GDP was 38.6% of the American GDP per worker. So we are really driven, powerful people. And American industrial, if not undercut by globalism, bad tariffs and bad policy and restrictive policies, which are now in a limited government cycle, we will be back in a Keynesian higher government cycle in the future. But right now, we're unleashing American industrial, and it's gone from the fourth asset class to right there, matching yields with multifamily. And here, what's new? 10 years ago, industrial was like 20% vacancy, 10 gaps. It went down to 5.5 in Class A industrial right before the Fed raised. So people are clumping, industrial into kind of the downturn. That's not it at all. It popped up, did really well. A lot of stability there. It's going to have there's a lot of road for industrial ahead. So multifamily too. America's great. I would say this. It is a great time to look for distress. There are real people. I'm a distressed assets veteran. I'm probably saving people who are losing, hundreds of millions of dollars of equity right now. There is distress too. So pay attention to distress in the meantime. But if you're going to buy now. Replacement costs are low. Cap rates are higher. Try to get good situations. Don't worry about the interest rates. They're going to come down later. Put some extra reserves in. Get to tomorrow. Refinance. Get some great cash flow in 3 to 5 years. Doesn't happen to happen tonight. And keep moving.
Are you seeing with this great onshoring, like, are you seeing basically the demand for all of these warehouse facilities going up, and that's what's driving these rates higher? Is there, what is that demand or
it's consumer demand? It's actually product demand for American productivity. There's a lot of changes in the market. They immediately get to, if you have something, you can't get it to the consumer. It has to get there. It has to get there fast. It has to be made fast. Has to adapt fast. Our cutting American edge is our technology over other countries, right? In a great legal system backed by a tough workforce. we're tough people. So yeah, demand, and we're hyper consumeristic. America is hyper consumeristic, right? So yeah, all the demands there. There's a lot, and as I said before, there's a lot of accretion, a lot of aggregation, a lot of efficiency. There's a shadow side though, Pascal. The shadow side is that as mom and pops get swallowed up, so does soul. But P is not a problem. There's a lot of soulful people in private equity empowering the country, making our lives better. But there are also some aggregations that are starting to like cheapen certain things and take advantage of things. We have choice. But the Midwest is also driven by we have great infrastructure and we have great trade policies. We're going through some hits right now for the short term. Also, the I went to several seminars on this. We're buying into a company with Hellfire missile skins and electronic components right now. The military is doing really well as well. That's definitely hard infrastructure. The government's actually creating value. It's not just burning; it's creating value. And electronic components, a lot of things are coming from China. China's a true inflation of it. There's a book that Three Chinas. They're in trouble. You can only mask the problem for so long. So I think the long game is continue to be better for us, especially now that I think we're getting a lot of globalist countries out of the pockets of China, where it might make sense for them, but not for the consumer.
Thank you for indulging me on that tangent. So I'd love to kind of pull us back to, if we are an LP and triple nets are interesting to us, this specific asset class, maybe even thinking about working with DWG Capital Partners. If you're new to this space, what are maybe some of the common things that LPs get wrong about this asset class?
Mm. Well, and I say this not to bar people from entering it, but you don't you don't want to do this one alone. It's so time consuming. Like you have to underwrite businesses with CPA, you do forensics, you do background checks, you do property. You got to find the best debt, you got to find the arbitrage, you got to go raise the capital. I mean, there's a lot involved. So I think sometimes it's like knowing the questions to ask and knowing when and the questions to find other people that trust an LP. Like sometimes understand the asset class, get the yields, and then find some people, some other. I think we just interviewed on another show. Invest Clearly, they just back They do referrals to LPs, right? You guys are like, I think one of the best channel in the United States. You're an amazing corporation. Honor to be here. But I think there's ways to vet people. Do two things, like figure out your yields, vet the sponsor, talk to other people. Like that's the best thing you can do. Like your best due diligence in the LP space in high net worth democratized technocratic society is find people that have succeeded with the sponsor and vet that. You have a right to call whoever you tear down the walls and make sure that person's high integrity. And also, hey, find a detective. Call me, if you need Butts to turn you on to one and say, hey, I need a background check. I'm going to put 100,000 with somebody. So spend $1,500. Make sure, because there are a lot of scared. We're hiring a new IR person, and there must be like 800 people have applied. I hired another person in our firm. There are 800. There are a lot of people in the market that are scrambling right now. There's a lot of hustlers in the market, the crypto space. I mean, I know somebody who's been ripped off 5 times. It keeps going back to that space. I'm American real estate man. I do believe in venture. Real estate's tangible, man. You've got rent, you got payment, you got a market. You might have reserves for a while, but it's a hard and tangible asset. But still, you have to check in. And it's okay if sponsors had a problem. It's okay if you're investing. Average millionaire goes broke a couple times, they say. And so it's okay if they've had a problem, but how do they handle the problem?
Maybe let me frame it in this way. What types of deals in your asset class would you not invest in that other operators are picking up?
Well, definitively, I'm sorry for some of my friends. Definitively office. I mean, office is tough. I would,
even with office being at all-time lows, you think it's still risky to be in?
Yeah, that's what I was about to say. I was about to say, if the basis is right and you have the tenant in hand, run, they'll walk to a good office. That's true. Office is just complicated. You want to be careful. I would say tertiary Class B office in the middle is still hurting. You got to be careful. We need maturity. We need some of the. Sorry, but I like your show because I can really talk about theory. But what we should have done, COVID hit, is we should have actually created $1 billion office mezzanine fund for for 7% money between 60% and 85%. And we should have saved our office owners when our government shut down office. And it's interesting. We took care of renters and we took care of we're all just a common man in America. Nobody's better than anybody else. And we really abandoned the office owners in America. It's something I still haven't made peace with. Because I'm like, why didn't you just have a mezzanine fund and say, sorry, your vacancy's down because we shut you down. You can borrow some money for it. I would have pitched in personally on my tax fund for that. But office is coming back. So you got to be careful in office. But right location, right area, etc. What wouldn't I invest in? That's a great question. Office I'd be the most careful in. I think self-storage and iOS is getting very interesting, but self-storage is getting hyper hot. iOS is all about location, indoor, outdoor storage. That's a very interesting space. We may diversify a little bit into that. Multifamily, multifamily right now, I would say if you can find good fundamentals on development, there's still multifamily still sub 5 on a national level. It's like 4.79 across the nation. Once again, investing isn't simple. It's about a mixture of psychology, economics, history, capital market. There's so much to it. So I guess the answer is 10 cap, 33 IRR, Pascal. I'll take it.
Yeah. Give me what kind of investor is best suited for maybe triple nets? I mean, is it a high cash flowing? Is it there's usually not a value add component because you're leasing back, right? So maybe there's a bunch of risk that's gone. Is there a lot of tax depreciation? How does that compare? Talk to us about that.
Yeah. Well, triple nets in the average space, right? You might buy a site. If you do a net value on a triple net, that means the lease is expiring. So you're going to probably take leasing risks to re-lease the space. So just triple net can be add value if it's at the end of the lease and it's a good location. You've got a good tenant, credit tenant. If you got a plan where you want to demolish the site and build multifamily, you can land bank by using triple nets. So don't forget that. It's like at the end of the day, my dad only bought land and he waited, because he had a little bit of ducats to do so. But if you can use triple net to cover land and eventually build, for example, Ventura, some of these old office buildings that have these little dinky tarot card readers and they die. And suddenly there's 88 units on that site. I'm doing a deal like that right now. That person played the long games, but triple nets are a great way to land bank, to protect your assets. You've got, let's say, Walgreens here, and you've got, distressed asset, higher risk here. And then triple nets, Walgreens, Burger Kings, Home Depots, DaVitas, the whole House of Blues, anything that could be triple net box here. It's going to give you over debt. Right now, debt's like, 6.5. So if you're buying something at a 7, there's not a lot of spread there. So you're going to have patient capital. You need tax. You need protection. Get out. And you can refinance it later. Take your money and move it in the American dream and do a 1031, right? So let your value go up for a while. Takes the money out. Go buy something else. Keep your money moving. Kick your depreciation down the road. There's a lot of reasons to buy base triple net. The most rewarding one is add value through future re-tenanting, rebuilding, etc. But triple nets themselves tend to be an asset preservation play. What we do is right here, and then let's say here's the add value bucket. I'm going to get apartment units, Pascal. There's the guy is death, divorce. I have the 4 Ds: death, divorce, debt, and dissolution. So the economy may be tight, my fellow investors, but the 4 Ds at BWG are these death, divorce, dissolution, and debt. So these things are always moving in any economy, and somebody might have played their cards wrong and bought a few too many Jimmy shoes. So if you pay attention, if you got good brokers looking for you, et cetera, they drive 85% of the market. I am one, and I highly respect them. Pay them, take them well. It's great to be a principal and take care of my own people. So if you find those deals that the triple net really makes it great. But if you get that multifamily deal up here and somebody has died and there's a moment, or they just weren't paying attention, or they're too tired to turn it over, then a smart guy said, wow, this is, expenses are 55%. They should be 32. They're not collecting rub. They're not adding another 30% to rent. And you've got a good LP, or you've got a nice deal. Go after that deal, get a 22, 23, go into development, get a 28, 30% return. Development, you might get high 20s, 30% returns, but you're taking the risk. You're building it, or your partner's building it. You got to take risks while you're building it. You don't know what the future is, but development's amazing. Multifamily add value, retail add value. You've got a big mall. There's a nail court to the left and Starbucks wants in. Let me just simplify it, right? Or Macy's left and you should run. Macy's left and you break it into a bunch of pieces and you turn it into something. There's all these ways to add value. Mostly it's just vacancy and turnover in retail. Great space, office, tenants are under market, roll them over. A lot of work right here. A lot of work. Adding value is work. Adding development is work. Triple net
and risk.
What's that?
And risk.
Triple nets, pretty safe. So they're like the bond of your stock market, CREOM. But our space is kind of fun. We're the nearly add value bucket. But what does that mean? It's a triple net deal, but we're backing a business with a little bit of intelligent risk, right? So we're going to get a little better deal, right? And then we are aware that they have this ability to expand and grow, and that we believe in them. So now we're going to get, maybe an 8.5 cap, or you might be getting a 5 cap over here, or a high 7s cap, 9 cap, debt's 6.75. Well, now you're not just breaking even. Now you're making 7 to 8 cash flow a month. You're preferential. You might make, let me break this down. So an IRR or ROI, we'll kind of blend them together. Your return on investment a year. What's a simple metric? Simple metric is if you take $100, people want to make $100 in 5 years, right? That's a 20% IRR, ROI. And IRR means a lot more variables in time. Dig it with your partners. But if something makes 100%, of $100 is made in 3 years, 33%, run, don't walk. That's development risk. That's add value risk. Okay. 10 cap, run, don't walk, right? But the rest of us have to play here and not in the God realm of yields. So here you have, you might be breaking even, making like 3 or 4%, but you're safe in your Walgreens and your dad's money's safe. And you just feel good about that. You're just going to wait. The inflationary escalations are going to make more money over time. You're going to pay down the mortgage over time. You're making, 7% in 5 years, and you're happy and you're safe. That's cool. Our space is we create value by making that tenant a bond, a value. Then we're able to give people like 20 IRR deals plus, where they could double their capital in 5 years, a 2x MOIC over 5 years, multiple invest on capital. And then here's the last part that's really fun in our space for me is on the taxes. Trump just put through the big, beautiful bill. 100% cost segregation is back. What does that mean? It's a Democratic bill, actually, that compresses your depreciation into your first X amount of years closer to the front. So cost segregated, accelerated depreciation. So I go out and I buy Pastel Wagner Beats Pro Incorporated, and he has $10 billion of machinery when I close on it. So I get to take that. I get to go to the cost of every segregated item, write it off as new over this period of time, in a shorter period of time. And that year, I put in $4 million, but my tax write-off through segregated depreciation, cost segregated accelerated depreciation, is $3.2 million. So I invest $4 million, but I've got like $3 million in tax write-offs. So you really get to take advantage of that. So you do get a little more cash flow. You get add value. So anyway, I hope I didn't get too long in the tooth there, but it's pretty fun sector.
Yeah. So a combination of all three. Judd, this has been incredible to have you on the show. Telling us a little bit more about triple net leases, schooling us about the asset class, what we should know. Where can people learn more about you, DWG Capital Partners, and follow you?
Yeah, thank you so much. The easiest thing to do is we're spending our time on deals and dinners, and we have an internal mailing. I talk about the economy there, and I do videos. Just DWGcapitalpartners.com, DWGcapitalpartners.com, DWGcapitalpartners.com. And just go there and log in. And when you click on, it'll tell us that somebody's joined. And then we'll verify you. We'll call you. We'll send you some stuff. We'll start to get our stuff, occasionally when it's out to market, get first looks. And I'll end with this is, the great part of it is now we're a community, 400 people. And we bought 100 million. We're going to do it 4 or 5 more times. And it is an honor and a pleasure to be here.
Hell yeah, I love that. And if you're listening and you want to access more deals like Judd's, I put together a simple resource to help you find and access those types of deals. And you can get those at the passiveinvestingstarterkit.com. And again, here on the Passive Income Playbook, part of the Best Ever CRE show, we drop new episodes every Thursday. So be sure to tune in each week for more conversations like this that help you grow as an LP. If you enjoyed today's episode, please subscribe, leave us a review, reach out to us on LinkedIn, say hi, and it really helps us, get to know who we're talking to. Thank you for tuning in, and I will see you next week for another episode of the Passive Income Playbook.